And we are live. Hey, thanks everybody for joining me. Sorry, we're 4 minutes late. I was just working with some stuff on the tech side. I appreciate everybody who's been waiting, and I'm really excited to get this panel kicked off. And I'm really excited to dive into everybody who's going to be on this. We have such a powerhouse panel. We're here to talk energy tech, the intersection, what's going on in oil and gas, what the future looks like, and sort of how that connects with technology. But first, I just want to give a shout out to Enercom and Oil and Gas 360 for being the people behind this that put this together in terms of the technology. You guys are watching this via their YouTube channel. We really appreciate them helping push out both the web form and this YouTube channel. They're hosting the Oil and Gas Conference, which hopefully is going to happen August 16th through the 19th. It's about the last investor relations conference show. They're taking registrants right now. So if you have any questions on that, you can check it all out at www.oilandgas360.com. With that, really what I want to do is I'm excited just to dive into this panel and get it going. So I hope everyone's got their drinks. Again, thanks for joining us. And like I mentioned, this panel is really going to tackle energy, technology, what the future looks like, and the intersection between them. And I'd love to introduce them all myself, but there's so many and their bios are so great. I'm just going to individually walk them through. And the first person I want to bring up is Jeffrey Can, who's the author of Bits, Barrels, and Bytes. He's an international speaker when it comes to digital technology, and he's joining us. Jeffrey, thanks for being here.
Delighted to be here. Yeah, so the book is called Bits, Bytes, and Barrels, The Digital Transformation of Oil and Gas. It's available. Hey, there it is. Thank you, Michael. It's available. Whoa, another one. It's available around the world, literally in the final process of signing a deal to have it distributed in a foreign language. I can't tell you who yet, but it's about to go global. These days, I teach digital awareness to oil and gas companies, and during this down cycle, this lockdown. It's all online now, but that's my main work. And I also speak to audiences around the world on this question of digital innovation in oil and gas. That's me.
Yeah, no, and we're definitely excited to have you. And I guess to my right, I don't know where he is on your screen, but we have Jeff Sapandra, who's the CEO of Heal Systems. Thanks for joining us today, Jeff. You both Jeffs are from you guys are in Canada right now.
Yep, both in BC.
So,
thanks, Michael. Appreciate the opportunity to contribute and participate. A little bit of my background: I'm a mechanical engineer, been on the downhole production technology, well engineering all my career, mainly with producers. The last number of years, it's been with the services side. We started realizing that developing tech in our own wells, we could create a lot of value and opportunity for shareholders developing tech in our own wells. So case in point, I'm now the CEO of Heal Systems, which is a Schlumberger entity. It's an exciting production optimization technology that Schlumberger is certainly going to take forward. So appreciate everyone's time today.
Yeah, no, I'm excited. I think you have a really unique blend of experience that I think is going to lend really well to what we're chatting about. And right below Jeff is Michael Soker, who's a fractional CTO and really was actually the brains and the operations behind this, Michael. So I first just want to say thanks for kind of rounding everybody and getting this all set up, but thanks for joining us.
Yeah, thanks a lot. My name is Michael Soker. I'm a investment banker and a fractional CFO. I work with companies to understand what their plans are and what they want to do, and particularly in times like these. And this all came about kind of from a conversation I had with Mr. Forsberg, and we just kind of had some basic questions around what's going to happen. And I think there's a lot of speculation. So we wanted to come together and take a look at what does the future look like and provide some certainty in a time of uncertainty.
Yeah, no, and it's going to be really good. And to his left, we have Dan Genovese, who's the Director of Consulting at Enercom. Dan, thanks for joining us today.
Hey, I'm glad everybody can be here. Certainly ecstatic that Enercom can host this for everybody. My background is started out in pure finance at Janus Capital and a Starwood portfolio company and Black Creek Capital, and then moved into a downstream energy and marketing, refined products, and then upstream, having worked at Chesapeake Energy and now here at Enercom. So happy to be here. Backgrounds in economics and finance, very similar to yours, Michael Tanner, and glad to be here.
That's awesome. And last, but definitely certainly not least, as Michael mentioned, the other brainchild behind this is David Forsberg, who's a venture capitalist and has his own fund, Ascent Energy Ventures. David, thanks for all your help putting all this together. Really appreciate it.
Yeah, glad to be here. Thank you. Yeah, my background is I've spent about 15 years as an investor. It began as developing execution algorithms for U.S. equity markets and working with a company that did that. And then it's developing long, short, systematic and quantitative investment models, and then more venture capital and private market opportunities. And we launched Ascent Energy Ventures about a year ago, focused on the opportunity and automation and digitization within the energy sector.
Yeah, and just another shameless plug for some of the stuff that I'm doing. Me and David had a really great interview on Enercom's Energy Expert Network that you should go check out if you want to get into some more of that trading stuff, which is definitely up my alley. But kicking this off, I think really before we get into some of the technology stuff and how we see the technology being affected by this game, I really would like to start out with having we'll start. I think we'll start with Dan Genovese and then move into I think both of the Jeffs. But Dan, if you can give us a sense of what you think the next 12 to 24 months really look like for oil and gas, from a real holistic perspective, I think that would serve well as we move into this conversation.
Yeah. What I hope to do is just paint a pretty broad picture. Certainly we can all agree that hyperbole has been kind of the rule of thumb, across the country for a couple of years, but no more than now. In that these are truly unprecedented times. Maybe the word unprecedented has been overused in the past, but we're certainly here now. Oil and gas has taken a hard 1-2 punch with demand destruction, with coronavirus, and with the Russia-Saudi price war, and so we find ourselves at extremely low commodity prices, and something has to give. I guess my thought on the OPEC plus deal is that it was kind of a head fake to the world market. More specifically, a head fake to Washington to kind of get Washington off their back a little bit. The announced production cuts were 10 million, approximately 10 million. In reality, it's 8, and that's assuming that nobody cheats and everybody actually produces. So with that as a backdrop, I think we're going to have low commodity prices for a while, and with all things being equal, with no changes, no tariffs, no protection, we're going to live in this low price commodity market for a while. Maybe gas will firm up a little bit as we get the curtailment out of wells and the associated gas related to oil. As that production gets cut, maybe we'll see supply constraint or tightening within gas and prices rise. But I'm not overly optimistic on that. So we're going to be living with this until something changes. Bankruptcies are more and more inevitable. And I think now's the time to do it. I think a lot of these management teams have been fighting the good fight. I think now's the time to just, give up the ghost, call it good, restructure, and come out the backside stronger. I think that there's mergers and acquisitions will naturally follow as balance sheets get cleaned up, and interested parties in merging aren't looking at somebody that's maybe a bad prom date in the sense that they have just a ton of debt that the other companies don't want to take on. I'd be remiss to not mention that with this environment, there's a lot of hard, loyal workers that are going to be laid off. And I feel for them. And I've been there twice in the down cycles. So I know how hard that is. And just from a personal standpoint, I hope that our industry can recreate itself on the backside and get some of these jobs back, because I do think that there's a lot of people that'll be hurting on that. If there's a couple takeaways, and then I'll kind of pitch it back to you. I think the upside is that this is a time to embrace the creative destruction that's going to come along with some of these bankruptcies and some of these mergers, some of these acquisitions. This will move valuable assets into the hands of the best operators, best management teams. There'll be improvements in operational efficiencies that lower break-even production costs, and technology and technique is going to be critical. As I mentioned to you guys before we came on, I just read an article with an unidentified E&P CEO that was quoted at this: in 5 to 7 years, we'll be an IT company that happens to produce oil and gas. The way oil is produced is fundamentally changing. We've always done the same thing the same way, and we have to learn a new way to do things. It's a challenge, but also
Yeah.
great opportunity to get ahead of the curve. So
100%.
I think that's what we're going to be talking about today is how do you get ahead of the curve? What do these changes look like, and how can technology be a part of that? So.
Mhm. And I think that's a good segue to bring in Mr. Can, who I think is our digitization historian and expert. And I want kind of your take on what's going on right now. And I know you come out from more of a digitization, but I think it's important to get, from your side, what do you see as going on with this next 12 to 24 months?
I'd touch on a couple of things that Dan had set out as our sort of our starting point, but two things come to mind for me. One is the speed of the downturn here is far more abrupt than other previous downturns. Normally, economies don't simply come to a slamming halt. There's usually a glide path down, and this time it was extremely abrupt, which left very, very little time for companies to prepare. And now, so that means there's a scramble to try and sort out through that shift. That's a big change, number one. A big change, number two, Dan didn't touch on this, but if you believe the analysis, it's very hard to get a handle on global oil production volumes with reliable data. But assuming a consensus view that we are anywhere between 10 and 20 million barrels per day of excess production over 2 months, we've overproduced 1.1 billion barrels of oil. And that's gone into storage somewhere. Now, a conversation about where all that volume is means you start digging into strategic petroleum reserves, national oil company deposits, third-party and merchant services, vessels, and so forth. All that supply glut is going to have to get unlocked. And it's in the best interest of producers to get their assets running. That's the only way you make money. You see, you got to convert the reservoir into cash. So we're going to have producers with cash needs coming up against a supply glut and traders who are going to want to get that product into the market. And so what that means is for months to come, we are going to have a lot of stress in the market as we've got barrels competing with each other all up and down that supply line. And so just to kind of add to the storyline here, it's going to be an unsettled and volatile market for months.
And Jeff Sapanj, I think that leads into, a lot of this focus. We've been talking about the U.S. market, but, you being based in Canada, how is the Canadian market handling this? And how is the outlook any different for the next 12 to 24 months?
Well, unfortunately, the Canadian market is even taking a bigger brunt of all this and suffering from built up with the lack of pipelines and everything else. It's been in a difficult, I'd say, downward slope for a while. This is potentially a pretty big nail in the coffin. I'm in agreement with everyone here that this is going to be 12 to 24 months of a lot of pain. I think for most of us that are still in the oil patch, we're going to have probably the most toughest time of our careers over the next 12 to 24 months. And that's sort of on a macro scale. I am worried about the Canadian oil and gas industry a lot. I've enjoyed the innovations that come out of the Canadian oil and gas industry or sector. But what I do want to say on a micro level, because I'm one of those people that focuses on tech development, is the interesting part of it is the mother invention, and this is a cliche as well, is pain. So I'm excited that this pain is going to drive a lot of innovation. I 100% agree with that. But on the contrast of that, though, is that innovation is going to require investment. It's going to require R&D. It's going to require experimentation and trials and et cetera, et cetera. Who's going to spend money on trials when they can't even reach break even on their current produced barrels today?
Yeah. And
probably for the next 12 months. So how to survive at below break-even prices is going to mean that innovation and R&D at a micro level is not going to be happening. So I just have concerns for that, and we got to look and say, well, how do we create this pain, innovate, and improve on on our break even or on our operating expense side.
Yeah, I'd underscore that too. I spoke with a tech entrepreneur this week and who has a half a dozen pilots and projects underway with various customers, and they've all been shut down because of this, the situation, all but one. And only one customer said, let's go live with a work from home workforce. And so the standard pattern in the industry, Jeff, spot on, is when you get into crisis, you pull the horns in, and anything that's not essential just gets set to the side till the clear days come. So that's the scenario we generally face.
Yeah, and I think that's a very interesting perspective. And to bring in David and Michael now from more of an energy tech side, do you see this, as Jeff mentioned, Sapanja, that this could be a catalyst for maybe some innovations as small? How does the outlook for the specific energy tech sector look? And are you guys worried that this extreme low price is going to have a huge impact on some of the development you guys are seeing in your sectors?
Yeah, I guess I'll field this. I think any prediction of the future needs to kind of start with the macro environment that we're in. And it's so volatile that it's hard to make any extrapolations beyond really uncertain guesswork. But the simple fact is we have the greatest economic contraction that we've really seen in 100 years. We have the greatest decline in oil price and the lowest price that we've seen in 100 years, 50 years, I don't know. We've got rapid and large decline in equity markets. We've got the largest government and central bank intervention in the history of the US, more so than in 07, 08. We've got huge GDP contraction. Goldman Sachs, I think, is calling for something around 25% decline. Bank of America is calling for a 35% decline. This would be 2 to 3 times the biggest GDP contraction that's ever been recorded. We have unemployment that is at record levels, that is already at 10 times what the weekly numbers have ever seen historically. And so this is a world in crisis. And it's rapidly changing as well, let alone the viral and other issues. And then so you've got these issues to contend with that affect the oil and gas industry, and then the subset of that, the energy tech industry. But I think I was mentioned today that the Pioneer CEO in his opening remarks said something to the extent, to the Railroad Commission, something to the extent of, no one wants to give any of us capital because we've spent the last decade destroying capital, and we've created economic waste. And I think that is a sad statement, but it also is true, and embracing reality is the first step to moving forward. But it's exciting for energy tech, because if you think about it, as these large companies start realizing this and investors realize this, one of the ways to get out of this pit, so to speak, and this wasteland, so to speak, is to embrace digital technologies on the operation side and the management of these companies and the workflows. And as the tornado has come through and eventually the skies will clear, and former barriers and walls that have kept adoption from sinking its teeth into this industry will be destroyed, and new ways of thinking and new ways of behaving and new solutions that previously took years to decide in a crisis will take months or days or shorter periods of time to adopt. And the fact is that there's an elephant to eat here in energy tech, and some of these companies, E&P companies, will eat this elephant one bite at a time, and others won't embrace energy tech, and they'll wake up in 5 years, 10 years from now and say, how did my competition compound capital so much faster than us and get so far ahead of us in technology? And look at them now, and they will be an IT company that drills wells. So I think the future is bright on the long term. The short term fact is that those that exist today are in a survival mode.
I think that's a really good point, David. I think from an energy technology and just from a startup perspective, and when I mean startup, it can be very late stage, but we have a record of kind of what happens in this environment from 08 and 09. We saw companies come out of the woodwork that would have normally not succeeded. We saw companies that normally would have succeeded that did not. And I think the thing to do right now is to value and understand what your offering is to your customer. Go back and understand, what is the value that I'm driving my customer, and in terms of energy, there has to be a very clear ROI, in my opinion. I think you have to understand that if I use this box, this widget, this platform, this hardware, I'm going to get a return on it. And I know that it's going to help bring down costs and it's going to help me be more efficient. So I think a return to core understanding, I think what we see in when the markets are great and when things are quote unquote easy, I think we see a lot of companies testing different things. Let's return to core offering. Let's see how we can bolster that. And let's see what and how much more value we can drive to our core customers. And that's what I would be doing. And that's what I would be looking at as an energy technology company. And I would also be looking at the customers because to everybody's point, we are going to see bankruptcies. We're going to see restructuring. That's going to be natural is going to shake things out. But at the end of the day, understand what the customer landscape is that you have and what value you drive to that as well. And I've been on the phone with CEOs and founders and VCs and everybody in between for weeks now. And I think a lot of people are starting to realize that it's going to become a little bit more competitive. On the VC front, again, we have records of this. I know that VCs right now are in a panic and are looking at their portfolio companies and how to best support them. But we'll look at Crunchbase, we'll look at the news. Rounds of funding are getting closed. Acquisitions are happening. And I think we'll continue to see that in the right formats. And what I mean by right formats is, again, value adds, right? Focus on what you're doing. So that's kind of my view is just focus on a customer, focus on a market share, and just continue to drive value as best as you can day in, day out.
Michael, I got to jump in and say, I appreciate your comment because I think the so what question is sometimes, in good times, the so what is often missed in technology. And I guess from the buyer side, where I've been on the buyer side of technology, where you almost sometimes feel like you're talking to Nigel from Spinal Tap. Basically, you say, so what? And they say, well, this one goes to 11, and you're like, so what? And if you guys missed that Spinal Tap reference, I apologize. But I think that's got to be critical, that return on investment. If it's demonstratable, I think at the core, the tech company has a really good chance in this new environment.
Go ahead, Jeff or Michael.
Let me give you one data point. I think we talked about this earlier in the week. The amount of people have been laid off in oil field services is in the tens of thousands. I don't know what the figure is, but it's high. What we are seeing on the technology side is an increased utilization in platforms that deal with oil field services. And that's March numbers year over year. So we have a contraction in terms of workforce out there actually working in the oil field, yet an increase and a pretty decent sized increase in the utilization of these technologies. That's a catalytic event to exemplify why technology and energy will prevail in the long term.
No, 100%. And along that note, I want to bring in Jeff Saponja because I think as someone who's run an oil company before, how do you strike a balance between a low oil price commodity and continuing to reinvest in ultimately technology that hopefully will save you money in the future? How do you balance those two things?
So you got to put return on investment into perspective. And the word I like to use around it is it's this certainty of that return. You can always come up and say, yeah, this is going to give me a 6-month payout at $20 oil. Great. But what is the certainty of that? So that's going to be the hardest part, because if it doesn't give you that return because you didn't foresee some risk scenario that occurs, so it's the risk, call it a return on investment is what I'm talking about. Let's say you go out and drill a well and you're very confident that certain product production is going to be there. But what's the certainty of that? If it doesn't occur, you can sink your company, especially if you're small. For tech companies and tech startups, bringing tech to the table is very important. And I agree. And here I'm monitoring wells for clients, from sitting in a spare room with an office. You can do that and provide comment and say, suggestion, do this today, let's get more life out of your ESP. All that stuff you can do today. But for tech startups and tech companies, though, is really the question they got to ask themselves is, when they bring value to a client, it's value certainty is what the client wants. You have to come to them and say, this is going to bring you certainty of value within this range with great confidence. Otherwise, no one's going to take on the risk or take the chance. So this is where you have to balance. Okay, bring value, but bring certainty.
Can I just address that real fast?
Yeah, I think this is a perfect time to bring you in.
I think there's two different types of tech that address the energy sector. The first is engineering tech, which the cone of certainty needs to be much tighter because your costs and your applications and your risk factor is higher. But there's also digital tech, and in the digital tech space, the cost of uncertainty is actually pretty low. You can implement things and fail fast and get rid of it and move on. And I think that difference in thinking needs to be applied here, because spending $100,000 on some data analytics platform where you get 3 months free trial to look at it, and if it doesn't deliver, well, your downside is 20 grand, but your upside could be 2 million. So, or making up numbers here, and you're let's say that it's a 50-50 chance that it fails or succeeds. Well, your cost is actually very, very small there.
Agreed.
And
I
so,
guess I have a quick question. What kind of, and not to get too specific, but what kind of technologies do you gentlemen see kind of maybe shining bright in the next 12 to 24 months if there were some specific subsectors of energy tech?
Well, back.
Sorry, go ahead, Jeffrey.
I was going to say back to David's point, the points of greatest leverage in technologies in oil and gas tend to be on those that don't touch the physical infrastructure and plant, because they're cement and steel and they run 24/7. They've got high management of change issues. So the point of immediate leverage will be where you don't have to touch a physical infrastructure. And so therefore back office is a fast, quick way to come and go and get some benefit, which is why I think, Michael, you said that the uptick in oil field ticketing platforms is high. That tends to be a bit of transactional and commercial data, which is why it's a win there. On the front office, though, Jeff, back into the ops area, where there are data sets of any kind that can be used to improve through analytics, as David's mentioned, analytics to drive even tiny improvements in productivity or asset utilization, have huge and outsized gains. If you can just change the behavior, even just a little bit, on attitudes towards how assets get run because you've leveraged some data and some analytics, there's a big win there. And you haven't actually touched the plant. You just work with the data.
And I'll add to that, and so take it right to the field level, is that sort of data analysis is critical, because it might not mean getting more production out of a well. The better answer, I think, today is preserving cash flow without having a reliability risk attached to it. So if I have a pump in a well that goes down because I ran it a little harder to try to get a little more cash flow to the well, the fool's game there. So the right answer might be appropriate analytics, lower the production in the well to give me 24 months of life on that pump that normally would have failed in 10. So it's that sort of, I think, detailed analysis and capabilities from data analytics and system. So it's not a pumper trying to monitor a well from a well site. There's going to be analytical capabilities that can give you that optimization around reliability, because that's where the focus must be, is preservation of cash flow. Because back to my certainty point, what producers need is certainty of cash flow. And there's nothing worse than having wells go down unexpectedly because they were, trying to get more and more out of the well, or whatever the action was being taken, where the consequences of well failure, and now I don't have the cash or the working capital to repair the well.
Yeah.
And Michael, to your question too, I think that if your company or the technology that's being offered sits or the revenue is highly correlated with exploration or drilling wells, I think you better batten down the hatches and prepare to survive in this desert that will be here for the next 12 months, I would suspect. If your company or solution sits more on the operations side, the business operations side, the management of current assets, even if you go through bankruptcy, if you're a vital technology to the operation of a company, you still get paid and your services still exist. The company produced 1,000 barrels yesterday. It went through bankruptcy today. It came out of bankruptcy yesterday. It produces 1,000 barrels. You still need to get paid as a creditor through that bankruptcy process, and you're still a vital software that you may not grow as quickly as you thought, but you certainly should survive or exist in your current state.
Yeah, we have a commenter who wants to talk about the difference between preventative and reactive maintenance when it comes to material cost savings in the field. Does anybody have thoughts around that?
Preventative versus reactive in the field.
Yeah, maintenance.
Yeah. Oh, and I know less about field because field is very, very tricky because it's the industry is so vast to kind of zero in on and say, well, this is exactly what you'd get. But I was involved in work in an oil refining complex where we looked at the difference between the two, and it was shocking. We're talking about a difference in labor costs alone swinging 40%, just because you're not having to pull crews in on an urgent basis to deal with maintenance, but you're planning it out, and so the gain can be quite substantial.
In the argument with preventive versus reactive is it's an equation you want to have weighted to preventative. If you're a company that's in reactive maintenance all the time, I guarantee your operating expense is going to be substantially higher.
Yeah.
So trying to use digitization, use analytics to be more preventative versus reactive is always going to be the winning side of the equation.
Hey, Jeff, is that sometimes easier said than done?
Absolutely. And that's why with reactive, I think you got to have a strategy. You can't get away from reactive. You're always going to have it. But your strategy and your processes and your workflows around being reactive got to be focused on having to be able to do things quickly with agility and with certainty. So it's all those things that when you have to react, it doesn't get into a compounding cost runaway because you're trying to repair something quickly that you haven't planned for, or whatever the consequence is. So you have to anticipate reactive stuff, but also limit how much you're doing, because you still have to concentrate some resources on preventative planning. You got to have those groups that are constantly looking ahead to say, hey, we need to do something here on this facility or this well in advance. If you lose that focus or that resource to do because they're getting pulled into reactive, I think it's a death spiral.
Yeah. And I'd argue on top of that, the amount of data you need to run a reactive business is very, very small compared to the amount of data you need to run a preventative or a predictive maintenance operation. You need a lot more data assets, and therefore a capability to interpret that data and massage it and make sense of it. Dan, you wanted to say something there.
Yeah, I was just saying, I'm a simple guy, and the old proverb or adage, an ounce of prevention. I mean, clearly that's a management discipline issue. If you have a culture that focuses on using data analytics and telemetry throughout your company to give you data that can be applied in a preventative way, you're going to be dollars ahead. I mean, that is almost a universal axiom. And if it's not being applied, which Lord knows we've all met with operators or all been out in the field, or many of us have been out in the field and have seen that that's just not the case. Sometimes that's just a management issue. It's a priority management issue.
Yeah.
Well, I think it's a cultural issue. We've been driven so hard to maximize production. And it's now a mindset change where less is more. Less production means I'm going to be more efficient. Less production means I'm going to be less reactive. I'm not going to produce that well that keeps going down every 3 months on a pump failure due to solids. I know that well's risky. Leave it. We'll deal with that well when the commodity prices are better. So it's that change in mindset that I'll say it again, less production is going to mean more efficiency.
Yeah, cost efficiency is going to be the driver in the market. Like we said, we're looking maybe 24 months in terms of just driving efficiencies.
but gain that mindset, everybody. I mean, we want less production. We have to offset oversupply. So why not just intentionally take on less production as a strategy with the benefit of lowering operating costs? Like that's the mindset I want to see the industry start trending.
And I think with that backdrop, I think it's, I'm going to kick it to David and Michael. You guys work with energy tech startups all the time. What do you do if you're seeing all this and you hear some resistance from someone, is about, hey, I'm not sure if the right time to invest. How do you get around that? And what are you doing to advise the companies that you guys are working with?
Well, I think twofold. And I want to share some data points. I think I mentioned venture capital early, right? That's a very small piece of the pie, early stage, and very important to innovation in general. When we start looking about and talking about where is capital available, I think we have to recognize that private equity is still out there, right? And private equity is a place where firms are fighting for deal flow. They're actively seeking it out. We know that there's roughly $1.5 trillion sitting around. It's one of the largest amounts of money has been set aside. And we know they're looking for deals right now, right? And I think as a startup company, what you have to do is you have to think 12, 14, 16, 18, 24 months ahead and start understanding what your roadmap is for funding, what your roadmap is for development, and making sure you have enough resources to get to the next point, right? It's all about the next finish line and how do you move from that finish line on to the next one.
I see the predicament though with private equity, and I've been working with private equity for many, many years, building startups and selling them and stuff like that. The challenge I see now though is the private equity still is limited. They're going to be very risk adverse because they admittedly we've all been beat up with our investments. The challenge is going to be grassroots startups. I got a technology idea I want to bring into play. I got no funding yet. I need to get some funding. So I got grassroots funding. What comes with that though, with private equity is this predicament around, call it dilution. So if I have to give away 80% of my company to get the initial startup working capital, is that something I'm going to want to do as an entrepreneur? Because the only way I hate to use the phrase, I'm just being controversial a bit here, but sell my soul and sell my tech and give it away to a private equity firm just to get some funding to move forward, because I'm not going to get funding from producers. I'm not going to get funding from the big service companies. I guarantee they're going to have all those R&D programs and funding shut down. So my only source of funding as a tech startup is going to be private equity. They know that. How are we going to deal with the challenge of this, I call it predicament of dilution?
It's a really good question. It's a tough question. That's what we're here for. I think a couple of things. First, I think that when I talk about private equity and the dry powder, we know that they're looking for opportunistic themes within certain industries. One of those top industries right now is definitely energy, right? Well, exactly what's going on, and we know why. I also, in my opinion, think that a lot of their investments are going to shift into actual investments rather than full-on takeovers. So I think that's definitely part of the consideration going forward. Depending on where you're at as a tech company, if you're, the tens of millions of dollars in revenue, if you're thousands of dollars in revenue, I think you are going to have to get very creative and you're going to have to get scrappy. And I think you're going to have a lot of conversations about where to find that capital. And unfortunately,
they're going to want to forecast a revenue in this market. So with maximum uncertainty right now, I'll call it, I was building a forecast the last couple of weeks, and in scenarios I was running, I'm like, okay, like how do you substantiate a forecast and say, yes, I believe I'm going to have this revenue with this, whatever, EBITDA, because that's what they're going to want to see. Is they're not going to put money in something they don't have some level, again, there's that word I'm going to use, certainty that they're going to have return.
Yeah. We're gonna. Dan wanted to pop in here, and then there's a question that I think both David Forsberg and Jeffrey Can should get in on. So, David, Dan, you wanted to cut in here for a second?
Yeah, no, I was just putting my finger up to the wind. I mean, I think forecasting and trying to determine, some of these return on investment type ideas when there's so much uncertainty in terms of what the value of the product we're producing is. I think that is a challenge in terms of calculating those ROIs and forecasting. If you're looking for venture capital, how are you going to you know, how are you going to come up with some of those valuations? I guess is going to be tough. Jeff, I agree.
How are you going to convince them to invest? That's
Yeah,
exactly.
exactly. I think it's going to be a tough lift, and I think to you know, our venture capitalist panelists, you know, what if I got a technology and I think it's great, how do I sell it in? And like Jeff said, how do you not come out, you know, giving up too much just because of this cycle? I mean, do you just sit on the sidelines?
If you have to give up that much equity,
Yeah.
it's probably not a good fit for venture capital or private equity. And the simple fact is that not all startup companies have the growth prospects to justify bringing in someone to share the pie with. And so that's one thing. The other is my valuations are to deal with uncertainty. And so we have a way that we deal with that and forecast at what we think is a probabilistic future. But right now, uncertainty and risk have spiked. And if the company was worth 10 million today, or I'm sorry, yesterday, with the new risk parameters, if nothing has changed with that company, it's now worth 5 million. And if other things have changed with the company, it's now worth 3. I mean, the simple fact is that that's what happens in these environments. Valuations have changed in public equity markets and risk profiles, and that gets applied and filtered through to private markets as well.
And you know, Mr. Can, there's this really interesting question that got dropped that I think you and David, I think, should really hit on it. One is, you know, between, you know, some of these emerging trends that we're seeing in technology, between AI, Internet of Things, data monetization, and smart logistics, those are sort of the 4 things that this person throws out. Is there a specific one of those or another one not mentioned that you think is primed right now to be the first to be invested in this low price commodity, like a specific wing of that digital tech space?
No, I think that list captures it.
Okay.
To be honest, the place of greatest value that I see is given that oil and gas has data assets already,
Mhm.
given how hard it is to introduce new data sensors and data gathering mechanisms, particularly in the front office and ops, and given the ease with which analytics and artificial intelligence, machine learning tools can be applied to existing data. And given that, you know, cloud environments are already there and already running, the greatest point of leverage is to take the existing data assets and try and make some money out of them. And that's the analytic, artificial intelligence, machine learning world. And so that, to my mind, is the point of if you've got a technology on the dime right now that does that, this is a good market to be in.
Yeah, and what other choices are producers going to have? Being predictive here, I see layoffs in the 50 to, and I've even heard up to 70% of the workforce in these producing companies.
Yeah.
The people that are left have no choice but to embrace tech at the highest level, to bring data into something useful for them to make decisions, to remain agile, to remain, you know, less reactive as possible. So that's going to be, there's no choice. They have to embrace it.
Yeah.
I totally agree with that. This is on the long term. There is not a choice. The energy sector is one of the biggest digitally laggard industries out there, and there's a crew shift, there's a demographic shift, there's a cultural shift, and all of those things. You're just going to be forced to adopt these things or become irrelevant.
Correct.
One thing I did want to raise, though, Michael, which was the way oil and gas companies buy technology has now fundamentally changed. And we haven't really kind of tucked that in under this dialogue about what has to be different for a tech company to be successful. But, you know, when you think about tech sales and how that actually works, it's carried out and first of all, you're aiming for an enterprise sale, ideally, and you're going to do that through face-to-face meetings, conferences, demos, and pilots. And I mean, we're not going to have face-to-face meetings of substance for a few weeks yet. So this is a curing time for those companies that are going to be successful. They're going to have to figure out what is my new sales model to deal with the fact that my customer now has a different behavior. One, there are far fewer of them, to Jeff's point, and 2, they're not able to buy the way they would have bought in the past. And so the sharp tech companies out there are going to be thinking that one through. How do I engineer a sale, even a sales meeting, in this environment with exceptionally busy people and really, really hard to get in front of them now.
Well, and I was speaking with a client the other day. He was saying, "No, Jeff, I got I'm getting 50 emails a day from various service companies proposing this, proposing that. He says, I can't look at all these things.
Yeah.
Getting
capacity.
bombarded. And so what is the new sales process? I agree. And when you take away the face-to-face, you take away the, I call it, when you're face-to-face, you have that implicit trust between each other. That's gone. So what is the new sales model? That is a great question, Jeff.
They
Yep.
should talk to Dan and Intercom.
Yeah, listen,
We're looking for a sponsor of the podcast as we speak, so we're open.
Yeah, but on the plus side, bear markets like this produce great winners. You know, if you go back over the last 20 years, bear markets have produced the winners, and so we're now into the ultimate bear market, so there will be winners out of all of this. What's that, Dan?
I'll let you finish, Jeff, but I have a question for the rest of the panelists with respect to mergers and acquisitions down the road. If you are inclined to acquire technology or implement technology, how do you know that that's 6 months, 12 months, 36 months down the road when you meet that prom date that you're going to merge with? What kind of systems should I be looking for, or platforms I should be looking for to make sure that that's an integration rather than an IT nightmare?
It's a really important question, and it's a very tough question, and it's timely. I'm always going back to data points. So for mergers and acquisitions in general, PwC did a really nice survey of CFOs. And what we found between March and as of April 13th is that roughly a quarter of the people have a decreased appetite for M&A. But 17% have an increased appetite, and about 30% are waiting to assess the situation. So I think timing in itself is shifting, albeit not as much as I honestly thought. Now, energy might be a little bit separate outside of this generalized information. I think what you have to do, and going back to this overall discussion, is understanding how to properly apply technology, right? You're talking about an IT nightmare. There are solutions companies, there are entrepreneurs and founders out there who have solutions that won't cause IT nightmares. I think it's about understanding the exact value that's being driven and how do you integrate that value. And that's an internal introspective thing that every company has to do now. And it's being forced by this catalytic event that is the pandemic and oil pricing. So I think, how do you avoid that? You have to understand the exact value that's been driven and where are you going to stick that value.
And I think you got to look for shared risk models as well. And it's not just saying, here, I'll give you a 90-day free trial. It's you got to look, and we got to put some pressure, and I'm going to be getting into politics here, on our governments, that they do have programs, they do have monies available to share risks in a project. They will take and cover 50% of a trial, for example. And I've been really, really pleased. On a positive note, I've been watching Alberta Innovates, the IRAP government grant program, and because I'm involved with some startup companies that have had some government granting, and these entities are still there. They are right up in forefront saying, yeah, we're right there with you right now. We have funding. We're going to support you. If you can convince a client to do a trial, we'll cover 50% of the cost. I'm very pleased to see some of that. So I just want to make sure everyone is out there. It's just not relying on their investors and things like that. There is these sources of funding and risk reduction that you should be aggressively pursuing.
Let me add to that. We may be as a panel, we may be overlooking the bigger oil and gas world, the international world, and so I know there may be some folks from the Canadian government. They told me they might be tuning in to this podcast. Because there's a potential for tech companies to look beyond the North American world and look to, say, South America or into Europe or into the Middle East. So we shouldn't just stop at our own borders and say, well, that's the opportunity set. There may be we may need to help our as tech companies think bigger and out into the larger world.
Yeah, along that point, I actually today had the pleasure of interviewing somebody in the specialty chemicals business for Entercom's Energy 360 network, and he specifically mentioned that because that part of this coronavirus outbreak is that the international customers have sped up their buying process very specific, and they've improved. They've been able to get things to the 1 yard line much quicker in this environment. So I think it's a really good point you bring up.
And you should also think about there's Techstars Energy, which is the Techstars program is an incubator based out of Boulder, Colorado. The energy focused Techstars is based out of Oslo, and one of the Calgary companies, Interface Fluidics, went there in one of their first classes, and it's backed by the national oil companies of Norway. And so that's another great avenue for some of these energy tech companies to get international exposure, management, training, et cetera, et cetera.
And
well,
I think
most importantly, get some working capital into the company. At the end of the day, you need working capital to move forward. So,
yeah, no, and I want to. There's a good question that got asked, and I think this falls in right along with Dan Genevieve's expertise, and it was really about how ESG fits into all of this outlook. That's ESG was sort of the something that was looked at that was was able to survive because there was this, but how does that moving forward as investors are looking specifically for that, how does that fit into this low oil price commodity? It was a question we had from the audience, which is awesome.
Gosh, Michael, I mean that came right off the last note I had here. In all honesty, is that I think all these changes and all this market dynamic that we're seeing as companies kind of reemerge from this, whether it's through bankruptcy, through merger, through acquisition, I think repositioning the oil and gas industry as a leader in ESG in the equity markets is going to be critical, and technology plays a role in that too.
But it's a double-edged sword, though. As Jeff, you pointed out, the trimming of the ranks in companies. Unless there was attention paid to this and oil companies have trimmed out their ESG expertise, or they've created conditions where there will be reliability or performance or safety issues, particularly out in the field, the industry may be doing itself a huge disservice. So we got to keep a close eye on that. And by that, I'm talking about, if you trim out the team that supervises for pipeline leaks and you get another pipeline disaster, all your energy gone into ESG to date, out the window.
Well, the interesting thing about that, Jeff, is that's where I think a lot of the processes where we've used team and human capital to go out and monitor, whether it's a well site or a pipeline. I think technology that opens the door to technology in these spaces. There's a lot of automated monitoring that can be implemented and is wide open for this.
Yeah, exactly. We should see robotics, autonomy, and other technologies that enable a remote supervision of assets should get a bit of a boost here, quite frankly. One, we won't have the people to run around and supervise them. Two, the ability of machines to control those assets better is a solid play, and we may need it just to meet ESG targets. So,
yeah, absolutely.
Yeah, I think energy tech is a bridge to ESG for the industry. And if you think about it, I mean, 100 sensors are far more accurate than a guy driving around in a truck.
absolutely.
Very true.
Unless you're the guy in the truck.
Yes.
Yeah, sorry, I'm just watching right now, and I just want to make sure my computer screen isn't funding me. Is crude oil now trading at $26, or is that just me? No, crude oil opened up and is now up $6.60 during this conversation. So just that's a good way to end it.
So we
right
moved
now.
the market.
We did. This conversation has legitimately moved the market. They've been so positive. And I refreshed my screen. I'm not kidding. It's 26.48 right now, up 33%. Opened about 45 minutes ago. Whew.
Wow.
I was literally scrolling, looking on my ticker. I was like, I don't see any necessarily thing that dropped other than maybe some of this virus stuff, but. What a good way to sort of wrap this all up on a positive note.
Yeah, there you go.
Yeah.
But and really before we end it, and I we're coming up here on the hour mark, and I've just had a blast being able to sit here and listen to you guys back and forth. I know I've learned so much. I want to give everybody an opportunity to sort of give their final 30-second minute wrap up on today, and I'll start with Michael Soker. Thanks again for setting this up, and just before we let give us your final thoughts, and we'll do that around the table.
Yeah, look, unprecedented times, right? Double whammy for energy. A lot of pessimism going on, a lot of uncertainty. There's a couple things I am certain about. I am certain about the innovation that can occur during times of great pressure. I am very optimistic about the human condition as being optimistic, and basically just moving forward. I mean, if you're running a startup company, a technology company, if you're dipping into energy, if you operate pre-rolling energy, there's a way to survive this. You have to get creative. You have to go back through. You have to understand, to Jeff's point about modeling out what the future looks like. I spent weeks building all sorts of scenarios, understand what it looks like, get your team on board. And the strong companies will survive this. They'll come out stronger, buying up assets probably at a discount. And we're going to see the world change quickly. I'm excited because this is a catalyst for adoption of technology. We've talked about it. Mr. Can, you've written about it. This is the case in point being made that all these companies have to move forward with technology.
Yeah, I know. I'm just honestly just trying to see if there's any news about why we're up $6, but it's not really dropping right now. It looks like, all I can see is that it looks like, Trump's expected to open up the economy sooner, but really, who knows? So, sorry to, throw that off in the end, but, Dan, to wrap it up before we let you go, is there anything, we missed you want to bring up in this conversation?
Sure. I'll kind of end with a little bit of an optimistic message, and that was, I have 3 kids, but my 2 boys are a year apart. And I remember my middle son, Joey, he loved to build Legos, and his little brother came in and kind of destroyed his little Lego town that he was building, and there was much weeping and gnashing of teeth. And I told my son, I said, well, gives you an opportunity to start over. And a couple hours later, what he had created was substantially better and nicer and cooler than what he had. So I see this as a time, and we use the term creative destruction. Listen, I think if we keep our eye on the ball, we implement technology, we're managed by great teams, I think we'll come out better. I'm fortunate to be at Intercom. We are at the intersection of good ideas, capital, and customers. And so I love what we do for our clients. I love what we do at our conferences. And I think technology more and more is going to be a player over the next couple of years for us.
Mr. Forsberg, thanks for joining us today.
Thank you. Glad to be here. I think that the next 12 months are going to be difficult, and I have no illusions about that. But I think the long-term trend here is that this is an opportunity. This is a step change in how this industry operates, and there's a generational opportunity to define a sector and to change the way that it operates. And it's one of the largest, if not the largest, industries in the world as the global feedstock for everything that happens economically. So this is a really great opportunity.
Mr. Can, I know you are, you have a lot of stuff going on. Can kind of wrap it up here and anything we missed?
Oh, just a couple of things I would just want to remind. Watch the supply glut because that is a bit of a wild card as to how long it'll stretch this all out. System shocks like this are a great time to battle test companies. And so for the VCs and the private equities who are investing, they're going to use this as a way to stress test the management teams that they're dealing with. So if you're a tech company, you're listening to the show and you're a tech company or a founder, just be aware the board on the other side, your investors are really watching you to see how well you do. And but this is a once in a lifetime opportunity. Had never happened in my lifetime. So this is a once in a lifetime opportunity. And now's the time to shine.
And real quick, just before I forget, Mr. Can, if you can mention the audience, we are making some copies of your book available.
Oh, yes, that's right. So I have a handful of audiobook versions available, and we're going to draw some names to hand those out. So if you registered for the show, we'll do a name drawing, and I will email you a code that you can use to access audiobooks. And we're also going to do a drawing for some hard copy versions, which will be autographed by me. I'll be shipping those out tomorrow. And so we'll get a hold of the winners of those who participated in the show here today.
Yeah, we'll make sure to facilitate. And last but again, but certainly not least, Mr. Sapanja, thanks for taking your time joining us. Is there anything you'd like to wrap us up with before we leave?
Yeah, I'll just say, everyone, I've had to learn from my kids over the last number of weeks. I've been amazed how quickly they embraced the change, working from home, how quickly they pivoted to doing online classes. There was no complaining. There was no, this is whatever. They just did it. And so it's the youth of kids and teenagers, how fast they can embrace change and adapt, and using technology, are comfortably doing their courses, writing their exams, and doing all these things. I was like, wow, I expected this to be chaos, and it was not. So I said, you know what, that's awesome to see the kids be able to adjust at that. And we got to look at that and say, yeah, we got to be just like that.
Yeah.
And chin up, this will turn. So this is all about the next little while is coming out of the back end of this. And that's where the hard part is. And yes, it's going to be painful, but it will turn. And every one of us needs to be positioning for that turn. So we're in front of it. So when it turns, we can enjoy the upside of it. Thank you.
Exactly. And I think we'll leave everybody with the best comment we had from Daniel Seaver, who said everyone's hair is looking great considering our circumstances. So we all killed it with the hair game. So we really
listen,
appreciate
I just want to say, as we close, I just want to say, hey, we want to thank everybody that tuned in and tuned into the live stream. That eventually watch this on Oil and Gas 360, and as we distribute out against our LinkedIn accounts or whatever, happy that everybody was able to join us. Hopefully we were informative for you.
Little photograph for Twitter.
There you go. So again, appreciate everybody who's joined us, and we'll let you guys get back to your evenings. And thanks for taking the time. And we'll see.
And Michael, my School of Mines comment, I do apologize, but
it's okay.
I have a different choice for you, School of Mines. So thank you.
It's all right. I still got mine here. We're good.
Have a great night. Thank you, Michael. Looking forward to the
See you
next one.
guys. Thank you all for joining.
Thank you.